This is Catherine Robson and Jonathan Scholes from Affinity Private. Between us, we've got 35 years of advising clients, and we think that this year's federal budget, while it might seem boring on the outset, is really pivotal for individual investors to understand and to take actions to optimise their position. Today we're going to be talking about general advice, but always delighted to meet with you on a one-to-one basis to talk about your specific affairs and how we might be able to help. So what we'd like to cover is the context within which this year's budget sits, both globally and domestically, the key takeouts from the budget itself, and in lots of ways how small target they seem when you first look at them, the superannuation specific changes, and they're really important because they are the biggest changes that we've seen in a decade, and Jonathan's going to talk about them specifically. And then we'll talk about the practical applications for what you can actually do to take advantage of your position under the new rules. And then we'll talk about what we say is the investor's secret weapon, the practical ways that you can amazingly enhance your returns from your own investments. So Australia's found itself in a political quagmire for the last 6 to 7 years. We've had frequent changes at the top, and what's been the default setting for many politicians has been to talk down Australia. So this whole notion of debt and deficit and disaster has not been helpful for investment confidence or consumer confidence. But the reality is Australia's just not that bad. When you look at it relative to its place around the world, on many measures, Australia ranks very highly. So this is a measure of Australia versus other countries in the world as measured by income per person or GDP per capita. And being in the top 5 nations in the world really means that as investors and savers, there should be no reason that we shouldn't be able to take control of our own financial independence. What are the challenges though? Well, clearly we sit in an economic environment where monetary policy has started to lose its force. So this is a picture from the front page of The Economist, and many central banks around the world have reduced rates to very low levels, including the Australian RBA, which last week reduced the funds rate to 1.75%. And so this year's budget is important because monetary policy will no longer be able to carry the heavy burden of economic stimulus as it gets to very low levels. The other thing to bear in mind is that we think that deflation is something that is happening only in far off lands like Japan and places in Europe. But the reality is when you look at the Australian inflation rate, it is now substantially below the RBA target band of between 2 to 3%. So while we don't have deflation at this point, it is certainly something that could be on the horizon and strengthens our argument for the importance of fiscal stimulus and fiscal management. The other thing that this year's budget highlights is the trend from the surpluses that we saw in 2005, 6 and 7, while the mining boom was in full force, and when the Howard Costello administrations gave back to the population generous tax cuts and very generous superannuation concessions. We see as the global financial crisis took effect, and we've moved beyond the mining boom, that government debt has increased. And this administration and those that it that came before have been focused on how to manage to stimulate the economy without significantly amplifying the government debt burden. So what was in this year's budget? Well, the big picture is that really it is a pre-election focused budget, and that's no surprise because a number of days after the budget announcements, there was the calling of the election for the 2nd of July. And what this government is trying to focus on is walking that fine line between demonstrating its economic credentials and showing itself to be economically responsible, and yet not announcing reform measures that are controversial. And so we expect that there are likely to be additional announcements during this marathon election campaign between now and the beginning of July. So this is not the final word, but certainly that has shaped our expectations around what we're likely to see in coming weeks. The next is that there is this focus on managing government debt and certainly trying to bring the budget back to surplus. We would argue that during a period of lower economic growth, that spending is actually helpful and a necessary stimulus, particularly if monetary policy is a weakened tool. The budget forecasts suggest that there will be able to be a return to surplus by 2020, but that certainly remains to be seen. GDP growth is aimed at 3% per annum, and if you looked at GDP growth in isolation, you'd be surprised that there wasn't a more aggressive growth target, given that our GDP growth at the moment is around this level. But there is the expected continued headwinds of a slow economic environment globally and low commodity prices and an Australian economy in need of structural reform as we move forward. The unemployment rate is focused on 5.5% by 2017, and that's not much above full employment. We talk about full employment being around that 5% or just under 5% mark. And while we haven't seen a shift in the unemployment rate, it'll be interesting to see whether, when you dig into what the unemployment picture in Australia looks like, whether you get this picture of people being underemployed or people not moving between jobs and having labour mobility in an environment where there's concern about job security. Inflation is targeted in the middle of the RBA band at 2.5%. And interestingly, usually we're focused on bringing inflation down into the band, but as we've talked about in previous slides, actually making sure that inflation doesn't get too low will be one of the main challenges. There'll be an uplift in revenue from superannuation, but as Jonathan will talk about in a minute, there's not a huge amount of additional revenue coming from the announced superannuation reforms, and there is also a relatively modest contribution to revenues coming from additional taxes on multinational companies. What's the good news in the budget? Well, as we've indicated, it's all pretty small target stuff. So there's a reduction proposed for the company tax rate, albeit progressively over a 10-year period. So I think that there's a general level of scepticism about whether that will be implemented as initially announced. There are some small tax cuts for middle income earners, with the threshold rate being increased from $80,000 to $87,000. And there's also the additional contribution of revenue by these reforms in regards to multinational companies, bringing us in line with other jurisdictions like the United Kingdom. Who do you not want to be under this budget? Well, you don't want to be a frequent traveller, as some government services like passports are becoming more expensive. There's additional costs to consumers expected in terms of excises being passed on to consumers on alcohol and also additional taxes on tobacco products. One of the things that's not been focused on terribly much in the commentary has been the reduction to tertiary funding, that while wasn't a new budget announcement, was certainly included in some of the budget estimates. And there's some level of contradiction where there is a focus on creation of jobs and economic vibrancy if you're not committed to further higher education. And then the final one is additional cost to consumers for goods purchased over the internet through online providers like ASOS. What do we things missing from the budget? Well, one of the things that we probably would have liked to see more of was spending on infrastructure, and the states, both New South Wales and Victoria, have been reasonably active in their infrastructure announcements. But having myself spent some time in the Philippines recently, you really can see a straight line connection between infrastructure investment and productivity, or the absence thereof. So some of the more forward-looking, longer-term investments in things that will increase productivity would be very welcome. There was not much in the budget for low income earners, but as we've flagged, perhaps in the lead up to the federal election, we might see some other sweeteners being announced. And there wasn't anything that addressed housing affordability in Australia, which is a hot button issue. And certainly before the budget, the opposition were talking about reforms to negative gearing, potentially capital gains tax, even the age pension and its calculation all feed into a debate around how we make housing more affordable, and whether that long-held Australian dream of owning your own home is something to which as a community we still aspire. So in terms of where the big ticket changes are, superannuation was where all the action was. And I'll let Jonathan talk about the specifics in just a moment. But one of the philosophical departure points from previous budgets is this sentence we've included on this slide. This budget has sought to enshrine in legislation a change to how we think about superannuation, and moving it from the provision of retirement benefit and death benefits to members to being a substitute or supplement for the age pension. For us, there's two takeouts in that. The first is that there is a clear message being sent that the government at a federal level wants to move away from state-funded retirement support. The second is that the incentives which the government wants to provide is linked to the sort of level that people formerly could have expected from the age pension. Now that's quite a big change, to the extent that the current age pension is about $30,000 of income per annum, and many of us will want a retirement income stream well above that, and if that is the reference point to which governments are asking us to look, then we may, as Jonathan will talk about in a minute, need to think beyond superannuation as the pool of our retirement savings. So Jonathan, over to you. What's the specific changes?
Just further to Catherine's point, Catherine writes an article for Money Brain in The Age, and she wrote of a client of ours who has effectively decided to opt out of superannuation. And his point is more around he doesn't trust the legislative environment of which superannuation sits, and that will be an implication of this budget, in that there are so many changes that it will definitely promote some questions around whether or not super is the way to save for your retirement. We certainly think that it will be, but with some nuances which are relatively new. The changes specifically, so most of these changes come into force on 1 July 2017, and that is of course assuming that they pass through legislation. From 1 July 17 we will have a $25,000 concessional contribution cap, and that is for contributions that come via way of salary sacrifice or indeed the 9.5% superannuation guarantee. Everyone will have that $25,000 cap. On top of that, there's going to be high contributions tax for those of us that are lucky enough to earn more than $250,000. You'll be taxed at 30 cents on the dollar rather than 15 cents on the dollar. There's also going to be a $1.6 million cap on the amount of funds you can have in the retirement phase. That's typically been known as a pension plan. That $1.6 million cap also impacts clients that already have their money in the pension phase, and hence there will be some action that will be required to be took by 30 June 2017. In addition, there is a lifetime cap of $500,000, which applies to non-concessional contributions or after-tax contributions as they're more commonly known. That is backdated to 1 July 2007, which effectively means if you've put in $500,000 between 1 July 2007 and now, then effectively there's no more contributions going in on an after-tax basis for you. The good news is there's no penalty for exceeding that $500,000 cap looking backwards, although it will prevent you from adding any more to superannuation. They've also removed the work test for those over age 65. Previously, there was a need to work 40 hours in a 30-day period. That is now gone, and anyone up to the age of 75 can now actually contribute to superannuation, and there will be some planning opportunities in that space. They've also removed the self-employed test. This test really applied to those that were receiving some income from employment and some income from a self-employed source, and was reasonably confusing and difficult to implement. They've now removed that, and essentially anyone now can contribute to superannuation and claim a tax deduction, whether they're working or self-employed, up to that $25,000 concessional contribution cap. They've also introduced contribution averaging, which essentially allows you to average the $25,000 per annum over 5 years, and allow you to put in effectively $125,000 in any one financial year. We think this will help out those with lumpy incomes, those that are self-employed, or perhaps those that have a large taxable gain in one particular year. It's also been talked about as a positive for spouses returning back to work following the birth of a child, and that it does allow them to catch up on the contributions that they have missed out on when they weren't actually working. In addition, they have maintained and slightly improved the low-income rebate and also the spouse rebate. The low-income rebate effectively ensures that anyone on a low income won't pay any tax on their superannuation contributions, and the spouse rebate applies now to those that where their spouse is earning less than $37,000, and allows a contribution of $3,000 to go into that spouse's superannuation account, and for the contributing spouse to claim a rebate of $540 on that contribution. There'll also be tax applied to transition to retirement pensions. These pensions were very tax effective for those aged over 55 all the way until age 60, and really, was a very good planning opportunity. The government now will tax the earnings and the capital gains at 15 cents on the dollar, which effectively means that the product itself is somewhat redundant. It will be used in limited circumstances, but not to the same extent that it presently is. They've also removed the anti-detriment payment, which was a payment that was effectively a refund of contributions tax paid during a person's lifetime on the death of a member. This was an antiquated law which really became redundant following the changes in 2007. It's only now just been removed, and it makes sense to us to remove that particular payment. Let's have a look at an example for James and Kate. So James and Kate are 40 years of age. James is a lawyer and he earns around $250,000. Kate is presently not working, looking after their 2 young children, although she works in advertising and has the ability to earn around $200,000 when back at work. They're doing okay. They've paid off half their mortgage, and they really are trying to get their mortgage down. They've got around $200,000 in James's superannuation, and Kate has around $120,000 in super. They want to retire at age 60, and they want to live on about $150,000 per annum net in today's dollar terms in retirement. So what are the opportunities and the actions for James and Kate from this budget? So the first one is to talk about consistent and maximum super contributions. So we need to be thinking about adding money to superannuation much earlier than we previously were. The ability for us to top up when we're over 50 or even just before we retire is somewhat limited. So we need to make sure that we are adding in funds early as we possibly can and trying to get to that $25,000 cap. On top of that, James will be able to access the spouse rebate while Kate is not working, and while it's only $540, it will help with his tax bill. In addition, once Kate returns to work, we have the ability to use up the concessional cap for the years in which she wasn't working, looking backwards. So in this scenario, we've actually assumed that $50,000 is added into superannuation for Kate upon her return to work. We're going to look to try and even the balances up as much as we possibly can over time for James and Kate. So super splitting, where effectively James's contributions can go across to Kate to try and get those balances even. That would be the 85% of James's contributions effectively after tax. In addition, one of the implications of the budget will be, as we're limited in getting money into superannuation, there will certainly be an incentive to take greater investment risk inside the superannuation portfolio to try and grow your balance quicker. We have assumed in this model that there is a slight increase in the investment risk and hence the investment return. So given all this, will James and Kate be able to accumulate enough money in superannuation to provide their income stream in retirement? To look at the numbers, so if they do nothing and keep going as they presently were, they'll be able to accumulate about $1.8 million in capital at their age 60 in today's dollar terms. If they implement the changes recommended, then they can get to almost $2.5 million at age 60 in today's dollar terms, which is a difference of around $650,000. This then, of course, will provide their retirement income streams, and in the current scenario, James and Kate will only have enough capital to last until their age 77, while under the advice scenario, they can get to around age 88. This, of course, assumes that James and Kate haven't saved any money elsewhere, and as Catherine mentioned before, we certainly see the opportunity to look at different structures for retirement as being one of the implications of this budget. The second example is Ray and Jane. They're a bit older, they're 68 years of age, and they are a retired couple with around $5 million inside their self-managed funds. Ray has around $4.5 million, while Jane has around $500,000 in her pension plan. Jane hasn't made any contribution to superannuation over her lifetime, and hence hasn't used her $500,000 contribution cap. They need around $200,000 a year to live in retirement, and this is, of course, in after-tax dollars. The implications for Ray and Jane are they need to make sure that Ray's balance is reduced down to less than $1.6 million come 30 June 2017. That will require around $3 million to be effectively rolled back from his pension to superannuation, or indeed withdrawn from superannuation altogether. They need to consider where their income is funded from, so that is whether it comes from Ray's pension, Jane's pension, or indeed from Ray's superannuation balance. We need to try and add as much money as we can to superannuation for Jane. One of the benefits here is as the work test has been removed, we can add $500,000 to Jane's superannuation, even though she is 68 and not currently working. We want to try and assess the impact on their long-term position. What will these changes in the budget actually cost Ray and Jane? And ensure that the superannuation component is structured correctly in an investment sense to maximise the income that comes through and minimise the overall tax. And this would definitely have a focus on Australian stocks and those that are paying high levels of franking credits. Looking at how they're impacted, will they have enough to provide for their living needs? So in this scenario, you can see this is the current position. So Ray and Jane's accumulation balance actually grows quite steadily from $5 million towards $6 million by their age 92, which happens to be Jane's life expectancy. Under the new rules, they're still going to be fine, and they're still going to have over $5 million left at Jane's age 92. However, there is a reasonably large impact of around $700,000 over that period of time, and that is primarily due to the tax that they pay on the superannuation component, which adds up to around $500,000 over that 25-year or so period. Now, this is the magic of compounding, which we talk about in a positive sense quite often. However, in this scenario, they're paying tax the whole way from year one onwards, and this obviously compounds over time to effectively mean they're around $700,000 worse off. So a large impact, but the good news is for Ray and Jane is they are going to be fine, and they're still going to leave behind a very large inheritance to their children. I hand back to Catherine now, who'll talk a little bit more about the investor's secret. Thanks.
So it's easy to have listened to both of us over the last 23 minutes and think that it's all bad news. And many of our clients do tell us that they feel anxiety around what the global economic and market condition looks like, particularly when it's compounded by governments suggesting that they're likely to impose higher levels of tax on investors. But what we say to clients is actually, while all of these things are important, none of them actually are under our direct control. And as Jonathan said, one of the things that we're passionate about is helping clients actually focus on the things that will drive personal outcomes for them. And one of the most impactful areas is the decision-making process that we go through as individual investors. And as Jonathan mentioned, the regular series of articles that we write for The Age and the Sydney Morning Herald called Money Brain is all about how to understand how our brains are hardwired wired, and how you can hack or life hack some of those hardwirings to make them work in your favour. So why is that so important? Well, the starting off point is the fact that our brains really are not that dissimilar from the monkeys we evolved from. And there's a terrific YouTube video that I'd suggest you watch, and we've given you the link to it here, to give you a sense of, when you watch monkeys behave, you can see direct parallels to people in your own life, like your family, your colleagues, and your peers. But in the specifics, when you talk about investing, one of the things that's really challenging is the fact that we all suffer from loss aversion. And that is that we are much more sensitized, about twice as sensitive to the prospect of loss as we are to the probability of future gain. So in this example, if you give a monkey one apple, the monkey is very happy. If you give a monkey 2 apples, again, the monkey's very satisfied. But just like investors, if you give a monkey 2 apples and take one away, the monkey sensitively feels that loss and wants to make sure that it doesn't happen again. And so for us, what we would suggest is that there's a very strong behavioural advantage where you can understand those inbuilt biases and the heuristics that your brain jumps to, that just like a monkey, you need the opportunity to be able to step back from what your initial emotional response is to things, to be able to make a judgment call when it comes to financial management. And we are able to measure what that difference is. So there's a company in the US called Dalbar, and every year for the last 29 years, it has measured the rolling return of US mutual funds, so managed investment funds, and what the average investor has generated over that period of time. So the one that we're looking at is the 20-year period that ended at the end of 2014. And over that period, the average investor in managed investments in the US context generated about 5% per annum. And so that contemplates the return that individuals got after you took into consideration they're moving in between different funds, going into one particular fund, exiting another, exiting the market altogether, for example, if they got nervous, or adding more money at the top of the market when they felt more confident. And when you look at that figure, the response you may have is, well, that probably sounds about right, because that was a very challenging 20-year period. It had the Russian debt crisis, the Asian bond crisis, the inflation and then bursting of the internet bubble, the GFC and September 11 were all in there. But the reality is that actually average investors were outperformed by nearly 90% by the market itself. So when you actually look at what the whole market produced as a per annum return over that same period, it was nearly double. And this is where we are so focused for our clients on what this behavioural advantage represents. Because if you are able to capture at least market return in whatever the asset class you are investing in, if you can capture market return, thereby increasing it by about 90% relative to what you possibly would get if you were the average investor, that makes a huge difference to the sort of security that you can have once you stop working, and the speed at which you can build financial independence. And the interesting thing is that these studies are amazingly consistent over time. So those 29 years of data sets that Dalbar has put together, very consistent in showing this big gap between average investors and market return, and also very consistent across asset classes. So when you look at these same sort of studies on bonds and other asset classes, very similar between what the market produces and what the unassisted or the sort of average investor is able to take home for themselves. So what we would suggest in wrapping up is that while we continue to be in a challenging environment, both as we move through legislative change, but also in the economic and market environment, that we shouldn't get too downbeat, and that the most recent guidance that we've got in the budget is not as bad as it looked at first glance, but where we would suggest that the most benefit you can achieve is by focusing on things that you absolutely can control, and to be smarter than the inner monkey that your intuitive voice might suggest that you might be. So we look forward to touching base with you and helping you on your road to achieving financial independence. Thanks.